conceptual framework is the constitution of financial reporting. This constitution establishes certain concepts, principles, and guidelines that underlie financial reporting. This conceptual framework consists of three major parts. So part one is the objective, part two, which consists of two sides of qualitative characteristics and the elements, so the elements and the qualitative characteristics, and the third part consists of three parts, which is assumption, principles, and the constraints. So this is basically it. This is the conceptual framework. Next, we will go on to study each of those separately. The very first level of the conceptual framework is the objective, this one. And that is what we already know. Objective of financial reporting is to provide financial information about a reporting entity that is useful to present and potential investors, lenders, and other creditors, for decision-making purpose. That is the part that explains why we are preparing this financial reporting, the purpose of the financial reporting. So the next part of the conceptual framework that I'd like to address is the elements. The elements are already what are familiar to you. So we know assets, liabilities, equity, income, and expenses. Now, just to be clear, assets are the resources controlled by the company. Liabilities are the present obligation arising from past activities. Equity is I've explained it using different words, but it's exactly the same thing. So it's a residual interest in assets after we deduct all of the liabilities of the company. So that's the last thing that remains. That's your equity. And income is the increase in economic benefit, and expenses are the decrease in economic benefit. So just to differentiate, because I can actually imagine students asking, but assets also increasing when you add cash and so on. But in this case, we're talking about, for example, in income during the accounting period. Some event happens, such as sale. It doesn't have to be necessarily in cash, but you already know that you will have in your future inflow into your business of cash that will increase your equity, that will decrease your liability, and that's what the income is. And then there are expenses, again, decrease in economic benefit. It will result in the raise in the liabilities, maybe, or outflow of cash from the business. So that's the expenses. So we will talk about it in details later. Okay, so let's just cover the elements of the financial reporting. You are already familiar with those, but I just want you to see that these are also part of the conceptual framework, and they are known as the elements of financial reporting. We know assets, liabilities, equity, income, and expenses. Assets are the resources controlled by the company. Liabilities are the obligations that arose from past activities. Equity is residual interest in assets after deducing all liabilities. So it's different words, exactly the same thing, so no worries, you know what it is. Income is an increase in economic benefit. The increase in economic benefit that eventually will lead into the inflow. So let me just write it down so that it will be clear. So inflow of cash, or not necessarily of, inflow into the business, and also a decrease in liabilities, whereas the expenses are the events that eventually result into outflow. Let me just make sure that I can write it here. Sorry, just a second. I will move it up. So they will result in outflow from the business, and they will also have occurrences or incidents of increasing the liability. That's it. Now let's move on to explain the qualitative characteristics of the conceptual framework. Now, qualitative characteristics allow the financial reporting to be represented in a relevant manner. It provides the most accurate information, the most useful information for decision-making purpose of the investors. Yeah. So the qualitative characteristics, we can divide them into fundamental qualities. Yeah, the first type of the qualities or characteristics are the fundamental qualities, and those fundamental qualities are the relevance and the faithful representation. Now, obviously, by the just like the name suggests, relevance means that the information is relevant, and there are three characteristics that allow the information to be relevant. The first one is a predictive value. The predictive value, simply putting it, allows the information to provide certain predictions for the investors. Confirmatory value allows for that information to confirm prior expectations. And then materiality is an information that is material. Yeah, so if we, for example, remove that information from the financial statement, yeah, it will be uh, material to the decision making. So it will influence the decision making, and that's why we can understand whether the information is material, is it important or not. Yeah, so that's relevance. And the second part is the faithful representation. So again, we're talking about fundamental qualities of the financial statement or financial reporting. Faithful representation is more simple in concept to understand. We're talking about the how accurate the information is. Yeah, so we're talking about first completeness, neutrality, and free from error. Completeness is all of the information that is necessary has been provided to provide this faithful representation. Yeah, completeness of the information. Second one is the neutrality. Neutrality is, simply putting it, it's free from bias. Yeah, so it's a free from bias. It's neutral information that doesn't favor one side or the other. So one investor is, favored over the other, and so the information is not neutral. So we need free from bias. Yeah, information, neutral information. And free from error is the last one. Free from error, obviously, we don't want to have any mistakes in our financial statements, so we're looking for accurate, without any errors information in the financial statements. So these are our fundamental qualities of qualitative characteristics. And finally, we have enhancing qualities of our qualitative characteristics section of the conceptual framework. It's qualitative characteristics, enhancing qualities. Enhancing qualities are simply comparability. So we need our financial information to be presented in such a way that we can easily compare one financial statement with another. Verifiability. The ability to be able to check how accurate or correctness of the information provided in the financial statements is the verifiability quality. And timeliness. Timeliness is, to put it simply, the information that is not relevant for the specific period of time does not make that information valuable to me as an investor or an interested party. I need an information that is presented in a timely manner without any delays. And lastly, it's an understandability. All of the financial statements have to be presented in such a way that a reader can understand easily the information. Well, that is obviously given the fact that the reader is a financially literate and understands basic terms. However, still we need the information to be presented for us in an understandable manner, regardless of the fact that, for example, I am a financial accountant, or I'm just I don't know, simple housewife who just is looking for investments, yeah, to enhance the portfolio. So the information has to be understandable. Moving on to our last level of the conceptual framework, which this one, which basically gives us an explanation of how we build our financial reporting. It gives us specific assumptions, principles, and constraints. And let's start first with the assumptions. The assumptions, I'm happy to say that we already know some of them, and some other ones are pretty much the common sense. Yeah. So the economic entity concept, or sorry, the assumption, implies that the owner is not the same as the business. Yeah, it's not the same. Sorry, one line. It's not the same as business, meaning that when the accountant is building financial reporting, he considers the owner's finances and business's finances separately from each other. Yeah, so they are completely different entities. The next one is the going concern assumption. Going concern assumption sounds very interesting for a non-native speaker. So let's just be clear on the fact that just use the word going, yeah, going forward, going concern. This assumption forces an accountant to think that the business will exist forever. Forever. So we are not building our financial reporting assuming that maybe next year or the year after that we will go bankrupt. No. So we keep thinking of going forward. So going concern implies that we, as an accountant, always consider the business to exist forever. The next one is monetary unit. Again, you are already familiar with that one. This basically means that all financial information is reported using some denominator and as a basis for accounting measurement. Yeah. Next one is a periodicity. Periodicity assumption simply implies that a company can divide its economic activities into artificial time frames. Most common are, so we have monthly, we've done those before, then there is period of quarter, and then of course a year. Yeah. And last one is accrual basis. This is most recent one. We've discussed it very well a lot, and I hope that we will understand it much more clearer in the future. But accrual basis again implies that transactions that change financial statements are recorded in the time that they have occurred, not based on the cash movement. So not on the cash movement, but rather on the event happening in the period that it took place. Yeah, not cash movement, but when transaction took place. Yeah, that's it. We have finally reached the principles of the financial reporting. Again, we are in the same how section of the conceptual framework, which explains those guidelines and principles. So if you remember, we already are familiar with these, at least three of these principles. So historical cost, which basically implies that the numbers, yeah, the amounts recorded in financial statements, the historical nature, and they don't represent the current price at which we could sell or buy specific asset, but the price at which we have bought it. Yeah. so we bought it, for example, for $100. Yeah, so that's how we're going to report it in the books, despite the fact that it might have been actually increased in price, and today it costs, for example, 120. We still do not care for this amount. Yeah, so we care only for this. Revenue recognition principle, again, you're familiar with this one. This one implies that we recognize this revenue at the time of the performance. Yeah, the period of the performance. So regardless of the fact that I've provided service or I sold an item, I haven't received the cash, I don't care about that. I just care about the fact that I have performed my obligation. And now I'm just waiting for the cash to come in, but it still doesn't matter. I've done my job. Revenue has to be recognized in my books. Now, the expense recognition is closely related to our revenue recognition principle. And in American textbook, you will see it as a matching principle. That's what they call it, matching principle. Yeah, this means that you, generally speaking, match your expenses to your revenue. So in the period at which, for example, you've earned revenue of let's say $100,000, whatever expense that associated with that $100,000 will be recognized in the same period as this revenue. Again, I would say don't overthink this one yet. Just realize or just remember the fact that the expenses always follow the revenue. That's the part that you need to remember now, and for the future we will continue doing illustrations, and you will see in examples how it works. And finally, we have the full disclosure principle, which implies that we as an accountant have to make certain trade-offs to provide that information that is the most recognize the most important information, because we cannot really disclose everything. We can disclose only some of the information. Well, no, not necessarily some of the information, but let's just say that we as accountants make some kind of judgments, we make trade-offs, we make the input the information with details and condensation of the information that is necessary, and we recognize this as a full disclosure principle. Again, don't overthink it. It's very simple. We will again discuss it in the future in the class, but for now, just remember that we have three major principles, and those are historical cost, revenue recognition, expense recognition, and I would say full disclosure is the least so the item that demands least attention, because eventually you will be working with these three in practice. Now we came to our last point in the conceptual framework, and that's the cost constraint, which arises when it's excessively expensive to report certain information in financial statements. Now, it doesn't mean that just because some information costs a bit too much, we shouldn't report it. No. Again, everything will depend on how valuable that information will be to the users of financial reports. So if we identify that there is more, the cost now, if we assume that the cost will outweigh the benefit of reporting that information, then an accountant is allowed to use the cost constraint principle, this cost constraint principle, and not either not to disclose that information or to combine and report it as a sum, include that information not at a separate line, but include it into another sort of line in the financial statement, just like we had that with electric bill case in our example, where the juicer obviously uses the electricity. So, well, logically speaking, yes, we should be adding the electric bill or electric cost that is related to is associated with making the juice, because the juicer uses electricity, but we get the bill for the whole
place. We don't get the bill only for our juice maker, or we don't get the bill separately for each light bulb that we're using in the shop. So we get one total bill for the whole place that we're using, for our whole business. Now, in that case, our accountant makes the decision not to spend time to identify how much electricity bill was used to just to make a juice, but decides to add it all into the expenses. And even though we do lose a little bit from the cost of goods sold, we understand that the cost of making that calculation will outweigh the benefit. So that's basically the cost constraint.